Hi there, accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 9 from Survey of Accounting, Manufacturing Operations. By the end of this chapter, you should be able to describe the nature of managerial accounting, describe and illustrate manufacturing operations, including different types and classifications of costs, describe types of cost accounting systems, describe and illustrate a job order cost accounting system, describe a job order cost accounting system for service operations, describe and illustrate the use of cost per unit for managerial decision-making and performance analysis, describe just-in-time manufacturing processing, and lastly, describe and illustrate activity-based costing. So we know that there are two branches of accounting, or two main branches of accounting. The first is financial accounting, where the company is preparing financial statements to be used by external users, such as the government and investors. And there's a branch of accounting that allows managers, as they make numerous decisions during the day-to-day operations, they have a better idea of what decisions should be made. So in managerial accounting, it focuses on preparing information that is useful to management and employees. Thus, it's not constrained by rules such as generally accepted accounting principles. So for example, employees and management in particular, they need to make lots of decisions each day. So they need to determine, should we continue with a segment of the company? Is it profitable or is it unprofitable? They have to determine how many units of a product they would need to sell and things of that nature. So managerial accountants, they prepare reports that involve more subjective data, such as the possibility of competitors' reactions to a company's new sales price or a marketing campaign. Also, managerial accounting is not constrained to reporting data in periodic intervals, but instead they prepare reports ad hoc as needed by management. So here we have a distinction between managerial accounting and financial accounting. So as we know, under managerial accounting, information that is used by management, so it's not restricted to GAAP, generally accepted accounting principles, versus financial accounting, where transactions and events are recorded and reported using GAAP, because again, external users are using the financial statements. Managerial accounting reports are prepared ad hoc as it's needed by management to make decisions. Financial accounting, they're required to be reported annually. It could be a calendar year, which is from January 1st to December 31st, or it could be a fiscal year, which is any other 12-month period. So think of it from birthday to birthday. But some companies, they might also want reports monthly or quarterly, which is every 3 months. And the focus of the report on the managerial accounting, again, it varies by the type of decision. Maybe an employee runs the report. Maybe it's based on a manufacturing unit or process or product, as well as the company as a whole or segments within a company. And lastly, for financial accounting, the focus of the report is the company as a whole or segments within the company. So as it relates to a manufacturing company, we know that there's essentially 3 types of businesses. There's a business that provides services, all right, that's, pretty much straightforward. An accounting firm, a tax firm, a lawyer, they provide services to their clients. We also have what's called a retail or a merchandiser. This is like a Target or a Best Buy. They essentially purchase goods and then resell it to consumers. But in this chapter, we're learning about manufacturing companies. And these are essentially companies that take raw materials and then they turn it into a finished product. So here we see with manufacturing operations and costs, the operations of a business can be classified, as we just mentioned, as service, merchandising, or manufacturing. So the accounting for service and merchandising businesses, we saw it in earlier chapters. And in this case, now with manufacturing businesses, we need to determine how are they going to track the raw materials. So as it relates to managerial accounting, one of the primary objectives is to accurately account for manufacturing costs. So a cost is the payment of cash or the commitment to pay cash in the future. So if you purchase something on account. It creates a liability that the company needs to pay in the future for the purpose of generating revenue. So this cost, as it relates to manufacturing companies, is similar to an expense. In managerial accounting, costs are classified according to the decision-making needs of management. So for example, costs are often classified by their relationship to a segment of operations called a cost object. So here we have this example with a guitar company. We'll call it Q Guitars. Here we see the customer places the order for a batch of guitars. Here we see, obviously you start off with the wood. We have the guitar bridge, the guitar strings. From there, it goes through the cutting process, goes through the assembly, painting, and varnishing, and then we have this finished guitar. So again, that's the key distinction with manufacturing companies. They take the raw materials, the wood, guitar strings, guitar bridge, and they form the finished product. And this finished guitar, if you go to a B&H or you go to Sam Ash or one of these companies, the retailer, have the finished product from the manufacturer. So as it relates to the costs of a manufactured product, the cost of a manufactured product, it includes the cost of materials that's used in making the product. As we saw in the previous example, it's the wood. In addition, the cost of a manufactured product, it also includes the cost of converting the material into the finished product. So Q Guitar, they might use employees or they use machines to convert the wood and other supplies into the finished goods. So with that being said, the cost of a finished guitar, which is the cost object, includes direct materials, direct labor, and factory overhead. So as it relates to direct materials costs, manufactured products, they begin with raw materials that are converted into these finished products. So the cost of any material that is first and foremost integral part of the finished product is classified as a direct material cost. So to be classified as a direct materials cost, the cost must be both of the following. First, as stated previously, it must be an integral part that can be traced to the finished product. And secondly, it must be a significant portion of the total cost of the product. So you might see, with the strings, we have the guitar strings, and we know that if you have a guitar without strings, then you don't really have a guitar, right? But in this example, Q Guitar, the cost of the guitar strings is not considered a direct material cost. So it is an integral part. It can be traced to the finished product, but it's not a significant portion of the total cost. So therefore, the strings are not considered direct material. We have what's called factory overhead. So any indirect material, so let's say that someone is building a desk, the nails, the glue, the things of that nature, those would be treated as indirect materials, which would be considered a part of factory overhead. So we have direct materials, direct labor, and everything else is considered factory overhead, as we'll learn in a few. So next we have our direct labor costs. So most manufacturing processes, they'll use employees to convert the materials into finished products. So the cost of employee wages, that's an integral part. Again, it has to be an integral part of the finished product, is classified as a direct labor cost. So for Q Guitars, the direct labor cost includes the wages of employees, those who cut the guitar out of raw lumber, and those who assemble it. Some other examples might be any mechanics who work on the machines, operations and things of that nature, those who assemble a laptop computer if they're working for, a company that uses laptops. So much like direct materials cost, the direct labor cost has to be an integral part that can be traced to the finished product, and it has to be a significant portion of the total cost of the product. So for Q Guitars, let's consider the janitor, right? So the janitor, they clean the factory. Of course, they keep things clean. Maybe there's some, cuttings from the wood, string pieces that are on the floor and things of that nature. So the janitors help to ensure that the facility is clean, but it's not something that can be directly traced to the guitars that are manufactured. So therefore, the janitorial costs are not integral, and it's not a significant cost of each guitar. So therefore, these janitorial costs are classified as indirect labor, factory overhead. So as we see here, our factory overhead is defined as costs other than direct materials costs and direct labor costs that are incurred in the manufacturing process, and they're combined and classified as factory overhead costs. And just keep in mind, sometimes factory overhead is called manufacturing overhead, factory burden, sometimes it's called FOH, it's abbreviated. So the key thing to keep in mind is that all factory overhead costs, they're an indirect cost of a product, an indirect and an insignificant cost of a product. So some examples, here we see our heating and lighting the factory, repairing and maintaining factory equipment, property taxes on factory buildings and land, insurance on factory buildings, and depreciation on any factory plant and equipment. Factory overhead, it might also include any indirect materials and indirect labor costs that don't enter directly into the finished product. So two quick examples here, the cost of oil to lubricate machinery, wages of the janitor, as we discussed earlier, and supervisory employees, which is considered indirect labor. So as it relates to cue guitars, think about, the glue, electricity to run the machines, salaries of the production supervisors. Maybe they need sandpaper for the wood and things of those natures. Those would be considered indirect, so they would be a part of our factory overhead. So now we have what's called prime costs and we have conversion costs. So our direct materials, direct labor, and factory overhead costs, they can be grouped together for analysis and reporting. So two of these common groupings, one is called prime costs and the other is called conversion costs. So for our prime costs, this consists of direct materials and direct labor costs. And then we have conversion costs, which consists of direct labor and factory overhead costs. So our conversion cost, that's essentially the cost of converting that raw material into a finished product. And as we can see, direct labor is both a prime cost and it's also a conversion cost. So here we have exhibit 3. Start off with the direct materials, and then we have the direct labor, as mentioned, which is the prime cost. And then the direct labor and the finished product is essentially the conversion cost. For financial reporting purposes, the costs are classified as either a product cost as a period cost. So just keep in mind, we have prime costs and conversion costs, and then we have our product costs and our period costs. So our product costs, that consists of any manufacturing cost. And our manufacturing costs, as we just pointed out, are our direct materials, direct labor, and our factory overhead. Our period costs, this is essentially to, sell any administrative expenses. So selling expenses are incurred in marketing the product and delivering the product to the customer or the vendor. And then our administrative expenses are incurred in managing the company and are not directly related to the manufacturing or selling functions. So in order to facilitate control, selling and administrative expenses, they may be reported by the level of responsibility. So for example, as it relates to selling expenses, they might be reported based on products, salespersons, the departments, the divisions, or the territories. And likewise, administrative expenses, they may be reported based on the area, maybe, such as human resources, HR, computer services, legal, accounting, finance, etc. So with this exhibit, we just have a quick example of product and period costs for cue guitars. So our product and manufacturing, as we pointed out, is direct materials, DM, direct labor, DL, and our factory overhead, FOH. And then we have our period, which are our non-manufacturing costs, which include our selling and our administrative expenses. So the reason why these are important is because our product costs, they impact both our balance sheet as well as our income statement. So our product costs impact our balance sheet because our inventory, the amount that we have on hand to sell to consumers, that's reported on the balance sheet as inventory. And then our cost of goods sold is an expense and is reported on our income statement. So just keep in mind, as product costs are incurred, they're recorded and reported on the balance sheet as inventory. And then when the inventory is sold, the cost of the manufactured product sold is reported as cost of goods sold on our income statement. Our period costs, on the other hand, they only impact our income statement in the period in which they're incurred, and they never appear on the balance sheet. So just as a quick reminder, on our income statement, we see our revenue minus our expense accounts, and on our balance sheet, there are our assets, liabilities, and stockholders' equity accounts. So as it relates to cost accounting, our cost accounting systems, they measure, record, and report our product costs. So managers, they use product costs for setting product prices, to control operations, and develop financial statements. So we have two main types of cost accounting systems for manufacturing companies. The first is the job order cost system, and the second is the process cost system. So each system differs in how it accumulates and records manufacturing costs. So with a job order cost system, it provides product costs for each quantity of product, and each quantity of product that's manufactured is called a job. So with a job order cost system, they're often used by companies that manufacture custom products for customers or batches of similar products. So for example, an apparel manufacturer, right? Such as Levi's or H&M, or even a guitar manufacturer, as we're learning about Q guitars, they would use this job order cost system. Next, we have process cost system, and this provides product costs for each manufacturing department or process. So process cost systems are often used by companies that manufacture units of a product that are indistinguishable from each other and that are manufactured using a continuous production process. So an example of a process cost system would be oil refineries, paper producers, chemical processors, and food processors. So job order and process cost systems are widely used. A company may use a job order cost system for some of its products, and then they use a process cost system for other products. So in this chapter, we essentially focus on the job order cost system. So a job order cost system, as we pointed out, records and summarizes manufacturing costs by jobs. So we have the material inventory, sometimes it's called raw materials inventory, and this consists of the cost of direct and indirect materials that have not yet entered the manufacturing process. So we're going to continue using the guitar example. The wood is in the storehouse, right? So this represents the materials inventory. The wood, the guitar strings, the guitar bridges, glue, etc. Next, we have the work in process inventory. And this consists of direct material costs, direct labor costs, and factory overhead costs that have entered the manufacturing process, but are associated with products that have not yet been completed. So as often stated a lot of times in accounting, the meaning is in and of the wording itself. So work in process means it's not yet complete. Next, we have the finished goods inventory. This consists of the completed jobs that have not yet been sold. So here we just have an example of the flow of manufacturing. So again, we start off with the materials inventory. Once we transfer the wood, the guitar strings, the bridge into production, then it becomes a part of work in process inventory. And again, this consists of direct labor, factory overhead, and direct materials. Then from there, we complete specific jobs. It's in the warehouse. We have our finished goods inventory. And when we actually sell the product, then that is considered cost of goods sold. So it's important to note the flow of these manufacturing costs. So upon sale, a manufacturer records the cost of sale as cost of goods sold. The cost of goods sold for a manufacturer is comparable to the cost of merchandise sold for a merchandising business. So in a job order costing accounting system, perpetual inventory records are retained for material, work in process, and finished good inventory. So these subsidiary material accounts are kept in a ledger called a subsidiary ledger. The sum of the subsidiary ledger account equals the balance of the materials account called the controlling account. So we know that perpetual means continuous. When we are considering a merchandise or a retail company, it is tracked continually. Every time there's a sale, you're recording the cost of the sale, and then you are also recording the cost of the item that was sold. So similar, as we're dealing with a manufacturing company, the cost of the materials, work in process, and finished goods inventory, it's tracked on a consistent basis. So here in this exhibit, we have the controlling accounts and subsidiary ledgers for materials, work in process, and finished goods inventory. So as it relates to the material cost, the material account is a controlling account. So there's a separate account for each type of material that's maintained in a subsidiary ledger. So we'll have one ledger for wood. We'll have another ledger for the guitar strings, another ledger for the guitar bridge and things of that nature. So we have what's called a receiving report, and that's prepared when the materials that have been ordered are received and expected. So we, consider the quantity that's received to ensure that the quantity that we received, it matches the receiving report, and that the condition of the materials entered on the receiving report are good to be used, right? Because imagine if Q Guitar, they ordered a batch of wood and some of the wood is rotted. They can't use the wood, right? So they need to, inspect not just the quantity, but also the quality of the materials that are received. And whenever the supplier's invoice is received, it's compared to the receiving report. And if there's no discrepancies, then the purchase is recorded. All right. And if we think back to just the reason why this is important, think about internal controls, right? Oftentimes in companies, people steal. Assets need to be safeguarded. That is one of the key things why internal controls are put in place. They are put in place to see. You want to ensure that assets are safeguarded and protected from theft and damage. You want to ensure that there's accurate reporting that is taking place. So these are the reasons why there's this receiving report and why there's this supplier's invoice. And there's a step of processes that need to be put in place to ensure not just that, management has accurate reports, but we also want to make sure that no theft is taking place. So with the storeroom, they release materials for use in manufacturing when a materials requisition is received. So with this materials requisition, we'll see an example in the next slide. And material requisitions for each job, this serves as the basis for recording the materials that have been used. Again, depending on which manufacturer it is, individual might say, hey, we are issuing 50 units into work in process, but they pocket 10 of the units. So you want to make sure that the materials requisition ties to what exactly is being reported on the job cost sheet. So for direct materials, the quantities and amounts from the materials requisitions are recorded on the job cost sheet. And the job cost sheets make up the work in process subsidiary ledger. So most companies, they use computerized information processes to record the use of materials. So in such cases, the storeroom employees, they'll electronically record the release of materials. And then it'll automatically update the materials ledger and the job cost sheets. But again, computers are new in the accounting world. So think about it back in the day where things needed to be done manually. But now computers make it a bit more easier. But of course, you can't guarantee that fraud and theft and things of that nature don't take place. But it is an internal control measure. So here in this exhibit, we see materials information and the cost flow. So here with A, we essentially see the receiving report, the supplier's invoices for 10,500, and we see here the amount of the units that were received. We received 750 units at a cost of 10,500. And then in exhibit B, we see that we issued 200 units. And here we see 200 units were issued at a cost of $2,000. And now we see for material requisition B, we also see that we issued 400 units, etc. So now we see for these 200 units that the job cost sheet ties to what was issued. So as all of these transactions take place, it's definitely important to be, to understand the effect of all of these transactions as it relates to the financial statements. So for our transaction A, we know that this is the receiving report and the invoice from the supplier. So the effect of the accounts and financial statements of recording the supplier invoice and receiving report number 196, transaction A, is as follows. So we receive the units. We didn't pay for it right away. So therefore we have a liability. So we increase the value of our materials by 10,500 and we credit our liabilities for 10,500. It has no impact on our statement of cash flows. Why? There was no cash exchange, and it has no impact on our income statement. Why? Because there was no revenue earned and there were no expenses incurred. So for our transaction B, we have a summary of the materials requisition is used as the basis for reporting the materials of 13,000, 2,000 plus 11,000 used for the month, and the effect on the accounts and financial statements of the materials used in December is as follows. So for our materials, the value in our materials, raw materials, is decreasing by 13,000, and it's our work in process is 13,000. So we see that there's a net effect of 0 on our assets. We simply transfer the raw materials into work in process. And again, this has no impact on our statement of cash flows because there's no exchange of cash, and no impact on our income statement because this transaction has nothing to do with our revenue and nothing to do with our expenses. So as it relates to our factory labor costs, so whenever employees report for work, maybe they'll clock in electronically using their ID badges, or they log into a digital time card system. So whenever employees work on an individual job, the time that they work in that specific job needs to be recorded. So much like with direct materials, most businesses, they use computerized information processing to record direct labor. And sometimes they might log their time directly into computer terminals at their workstations. And in some other cases, maybe they use magnetic cards like a credit card to log in and out of their work assignments. So in this exhibit, we have an example of labor information and the cost flows. So with this exhibit, it essentially illustrates the time recording by employees for job 71 and job 72. So it states on December 13th, 2007, we have D. McGinnis, and we see that his work description is cutting. And then we have employee S. Andrews, December 26, 2007. His work description is assembling. So we have job 71, and then we have job 72. So it shows us here that on this 13th day, 2007, that he essentially spent 6 hours. He worked from 8 a.m. to 12 p.m., 4 hours, and from 1 p.m. to 3 p.m. So a total of 6 hours. His hourly rate is $10 an hour, so he should receive payment of $60. And then for S. Andrews in the assembling department, he worked a total of 8 hours, from 9 a.m. to 12 p.m., from 1 p.m. to 6 p.m., at a rate of $15 per hour. So he receives $120. So we can essentially associate the cost, the labor, with the specific job. So here we see that for D. McGinnis, job 71, the direct labor total is $3,500. So this was just for one day, December 13th, but for the entire December job, he spent 350 hours. And then the same thing for job 72, S. Andrews worked a total of 500 hours. So direct labor associated with job number 72 is $7,500. Next, we have transaction C. So a summary of the time recordings are used as the basis for recording direct labor of 11,000, which is the 3,500 for job 71 and 7,500 for job 72 for the month. The direct labor costs that flow into production increase the work in process and the wages payable because we have a liability to pay our employees. So we see there will be a debit to our work in process and a credit to our wages payable. No impact on statement of cash flows. There was no exchange of cash, and no impact on our income statement because this transaction does not impact our revenue or our expenses. So our factory overhead costs, as we mentioned earlier, this basically includes all manufacturing costs except direct materials and direct labor. So a summary of factory overhead costs comes from a variety of sources, including the following. We have indirect materials. This comes from a summary of our materials requisitions. Any indirect labor that comes from the salaries of production supervisors and the wages of other employees, such as our janitors. Any factory power that comes from utility bills, as well as any factory depreciation that comes from the accounting department computations of depreciation. Next, we see transaction D, and it says Q Guitars incurred $4,600 of overhead in December, consisting of indirect materials of $500, factory depreciation of $1,200, indirect labor of $2,000, and factory utilities of $900. The effects of the accounts and financial statements on the December factory overhead of $4,600 are as follows. So we see there's a decrease of $500 to our materials. There's a total increase to our factory overhead of $4,600. We record our accumulated depreciation. We also account for the increase to our liability for wages payable and the increase to our utilities payable of $900. Again, no impact on statement of cash flows. No cash was exchanged or received or paid. And our income statement has no impact. There's no revenue and there's no expense. So as it relates to allocating factory overhead, you have to keep in mind that it's different from direct labor and direct materials in that it's indirectly related to the jobs. So what this simply means is that factory overhead costs, they can't readily be identified or traced to a specific job. So for this reason, factory overhead costs, they're allocated to jobs. The process by which factory overhead or other costs are assigned to a cost object, such as a job, that's called cost allocation. Factory overhead costs are allocated to jobs using a common measure that's related to each job, and this measure is called an activity base, might also be referred to as an allocation base or an activity driver. So the activity base that's used to allocate overhead, it should reflect the consumption or the use of factory overhead costs. So for example, if we are dealing with a production supervisor's salaries, it could be allocated based on direct labor hours or direct labor costs of each job. So in order to determine the allocation, we have what's called a predetermined factory overhead rate. So factory overhead costs, they're normally applied or allocated to jobs using this predetermined factory overhead rate. So there's a specific formula. The predetermined factory overhead rate is computed as follows. So in our numerator, we have the estimated total factory overhead cost, and in the denominator, we have the estimated activity base. So in this example, it says Q Guitars estimates total factory overhead cost of $50,000 for the year and an activity base of 10,000 direct labor hours. So in our numerator, we have our estimated total factory overhead cost, which in this case is $50,000. And our activity base, which is the direct labor hours, is 10,000 direct labor hours. So therefore, our predetermined factory overhead rate is $5 per direct labor hour. And just keep in mind that the predetermined overhead rate, it uses an estimated amount at the beginning of the period. And this is because managers need timely information on the product cost of each job. So if a company waited until all overhead costs were known at the end of the period, the allocated factory overhead would be accurate, but it wouldn't be timely, right? So only through timely reporting can managers adjust manufacturing methods or the product pricing. So many companies, they use what's called activity-based costing for accumulating and allocating their factory overhead costs. This method uses a different overhead rate for each type of factory overhead activity, such as inspecting, moving, and machining. So applying factory overhead to work in process. Cubitar's applied factory overhead using a rate of $5 per direct labor hour, as we calculated previously. And let's say 850 direct labor hours were used in Cubitar's December operations. So based on the time recordings, 350 hours can be traced to job 71 and 500 hours can be traced to job 72. So using the factory overhead rate of $5 per hour, we determined that the factory overhead, the total amount, is 4,250. So here we see 71, job 71, 350 hours multiplied by $5 per hour for factory overhead is 1,750. And for job 72, 500 hours multiplied by $5 per hour is 2,500. And that gives us a total factory overhead of $4,250. So now that we have all of this information, we know the total product cost, and we know our product cost consists of our direct materials, our direct labor, and our factory overhead. So we have the total product cost for job 71, which is 10,250, and we have the total product cost for job 72, which is $21,000. So for transaction E, the factory overhead costs applied to production increase the work in process account, and it decreases our factory overhead account. So the effect of applying our 4,250 of factory overhead to production on the accounts and financial statements, as we see, are down below. And we know that there's no impact on our statement of cash flows. No cash has been received or paid, and no impact on our income statement because there's no revenue or expense. So as it relates to our factory overhead, it's definitely important for us to be determined if the actual overhead compares to the applied overhead, to determine if it was favorable or if it was unfavorable. So in this case, the actual and applied overhead usually differ. Reason being, sometimes the actual overhead costs, maybe it's more because, again, keep in mind, we're using estimates. So depending on whether the actual overhead is greater or if it's less than the applied overhead, the factory overhead account will have either a positive or negative ending balance as follows. So if the applied overhead is less than the actual overhead incurred, then the factory overhead account will have a positive balance, which is called under applied factory overhead or unabsorbed factory overhead. And if the applied overhead is more than the actual overhead incurred, then the factory overhead account will have a negative balance, which is called over applied factory overhead or over absorbed factory overhead. So whenever the balance of the factory overhead, whether it is under applied or over applied, it becomes the balance in the related overhead rate, it should be investigated, because if it gets too large. So for example, if there's a large balance, it could be caused by changes in manufacturing methods. So in this case, management now, they have enough information to say, hey, we need to revise our factory overhead. So during the year, the balance that's in this factory overhead account is carried forward. And as mentioned, it can be reported as positive or it can be reported as negative, right? On the interim, the monthly balance sheets. However, any balance in the factory overhead account, it shouldn't be carried over to the next year. So we know that on an annual basis, whether it is a calendar year from January 1st to December 31st or a fiscal year, any other 12-month period, birthday to birthday, companies, they issue their financial statements. So whatever balance is in this factory overhead account, it should not be carried over to the next year. Reason being, the balance applies to operations of the current year, so it shouldn't be transferred. So if the estimates for computing the predetermined overhead rate are reasonably accurate, then in such case, the ending balance of factory overhead should be relatively small. So for this reason, the balance of factory overhead at the end of the year, it should be disposed of, and then dispose of it by transferring it to the cost of goods sold account as follows. So if there's an ending positive balance in the factory overhead account, they dispose of it by increasing our cost of goods sold expense account and decreasing the factory overhead account with a credit. And if there's an ending negative balance, if it's over applied in the factory overhead account, then we dispose of it by increasing factory overhead with a debit and decreasing our cost of goods sold with a credit. And just keep this in mind that, the ending balance in the factory overhead account, it might also be allocated among the work in process, finished goods and cost of goods sold account. And this would bring the accounts into agreement with whatever the actual costs incurred were. But this type of approach is rarely used, and it's only required if there's very large ending balances in the factory overhead, and then you allocate them accordingly to work in process, finished goods, and cost of goods sold. But for the most part, everything is transferred to cost of goods sold. So for our transaction F, in this transaction, it eliminates the under applied. We had a positive overhead balance of 150 at the end of the year. So here we see we're decreasing the balance in our factory overhead account. No impact on our statement of cash flows. No cash was received, no cash was paid. But here we see there's an impact on our income statement. And the reason being is because our cost of goods sold is impacted. Our cost of goods sold decreases by 150, as does our factory overhead by 150. Next, we have our work in process. So during the period work in process is increased for the following: our direct material costs, our direct labor costs, and our applied factory overhead costs. So the balance of work in process for Q guitars on December 1st, 2007, the beginning balance was $3,000. And this relates to job 71, which was the only job that was in process on this date. During December, the work in process was increased for the following. There was direct material cost of $13,000, which was transaction B. We had that materials requisition. Then there was direct labor cost of $11,000. This was based on time recordings. And then we had applied factory overhead of $4,250. And this was based on a predetermined overhead rate of $5 per direct labor hour. So here we have an example of the job cost sheets. All right, so we see for job 71, the total job cost was $10,250. And then we also see the impact on our work in process controlling account, the beginning balance, and the impact on our direct materials, direct labor, and our factory overhead rate. And in order for us to determine the cost per unit, upon completion of our product costs, which again is our direct materials, direct labor, factory overhead, we total them. And then from there, the total is divided by the number of units that were produced to determine the cost per unit. So in such case, the total job cost was $10,250, and we essentially produced 20 units. So if we divide the 10,250 by 20 guitars that were produced, as we see here, 20 units of Jazz Series guitars. So that gives us a unit cost of $512.52. And we see that job 72, it was started in December, but it was not completed by the end of the month. So therefore, this job 72, it's still a part of the work in process. Hence why we see, there's no unit cost. So here for our transaction G, it says after the completion of job 71, it's transferred from work in process to our finished goods. For job 71, this transfer of costs, it affects the accounts and financial statements as follows. So we have a decrease in our work in process, and we have an increase in our finished goods. So the finished goods account is a controlling account for the subsidiary finished goods ledger or the stock ledger. So each account in the finished goods ledger, this contains cost data for the units that have been manufactured, the units sold, and the units that remain on hand. So in this example, we sold these goods worth $10,250. We transferred them rather to our finished goods to be sold. So here we see job order 71, quantity is 20 units. The product cost is $10,250, which consists of direct materials, direct labor, and factory overhead. And then here we see sold ship order number 643. The quantity was 40. The amount was 20,000. It shows us the date and the quantity and the amount. So for transaction H, it states, assume that Q Guitar sold 40 of the Jazz Series guitars during December for $850 per unit, and that these guitars have a cost of $500 per unit. So the effect of selling the 40 Jazz Series guitars on the accounts and financial statements is as follows. So we see an increase to our accounts receivable, and an increase to our accounts receivable simply lets us know that our customers owe us money. We are expecting to receive money in the future. We have a decrease to our finished goods, and then we have retained earnings of $14,000, because keep in mind, in order to make money, we have to spend money. So a few key things to point out, that when we're dealing with sales for a manufacturing business or sales for a merchandising business, they have the same effect on our financial statements, right? Reason being is because there's cost of goods sold versus a service company where there's no cost of goods sold. So the cost data can be obtained from this finished goods ledger. So in this illustration, 40 guitars were sold at $850 per unit. So if we multiply it, that gives us $34,000. And then we have the total cost of the units that were sold, the 40 units multiplied by $500 per unit, which gives us $20,000. So therefore, the effect of selling these 40 Jazz Series guitars, again, accounts receivable, we're expecting to receive $34,000. And our finished goods, which is the cost of the item sold, is $20,000. So that leaves us with a profit of $14,000. $34,000, our revenue, minus $20,000, which is our cost of goods sold. So therefore, the profit of $14,000 is recorded under our retained earnings in the stockholders' equity section of the balance sheet. And obviously, there's no impact on our statement of cash flows because no cash was received and no cash was paid. Next, this brings us to our period costs. So we discussed period costs earlier, and we know these period costs, they're used in helping to generate revenue during the current period, but they're not directly involved in the manufacturing process. So period costs, they're recorded as expenses of the current period as either selling or administrative expenses. So selling expenses, these are incurred in marketing the product, delivering the sold product to customers, and then our administrative expenses, on the other hand, these are incurred in managing the company, but it's not related to manufacturing or the selling functions. So here we have an example of these period costs. Again, selling consists of advertising, sales, salaries, expenses, commission expenses. And for our administrative expenses, we have office salaries, office supplies expense, and our depreciation expense on office buildings and office equipment. So for our transaction I, it says during December, Q Guitars incurred sales salaries of $2,000 and office sales of $1,500. So there's a total salaries expense of $3,500, $2,000 plus $1,500. So we decrease our retained earnings because we know with our retained earnings, there's 4 components. The first is common stock, which represents our investments by shareholders. Then we have our dividends, which represents distributions to our shareholders. We have revenue, which represents monies earned by the business because they sold the product or they provided a service. And then we have our expenses, which is essentially an asset that is used up or an expense that is incurred in order to generate revenue. So in this case, the company needs the sales team. They need those who work in the office. So that is an expense. that has a decreasing effect. So we see the decrease to our retained earnings, and then we also see it reflected on our income statement. There's no impact on the statement of cash flows because there was no exchange of cash. And obviously we didn't pay them right away. So we have this liability that was set up for our salaries payable. So here we see the summary of cost flow for Q guitars. So in this exhibit, it basically shows the cost flows through the manufacturing accounts of Q guitars for December. So increases are shown on the left side and decreases are shown on the right side of the account. So in addition, some of the summary details show the materials ledger, the subsidiary ledger for materials, job cost sheet, the subsidiary ledger for work in process, and our finished goods ledger, which is the subsidiary ledger for our finished goods. So the balance in materials is 3,500. The balance in our work in process is 2,100. And the balance in our finished goods is 10,250. Now in Exhibit 15, this essentially shows the income statement for Q guitars as follows. So we know that we sold 40 units for $850 per unit. So $34. Then we have our cost of goods sold. That gives us our gross profit. So just keep in mind, in order to calculate gross profit, is sales minus cost of goods sold. And then from there, we subtract our period costs, which consist of our selling and our administrative expenses. And after we subtract these amounts, we get our operating income, which in this case is $10,350. So sometimes job order cost systems, they can also be used for a service business. So a job order cost accounting system may be used for a professional service business. So for example, an advertising agency, an attorney, a physician, they might provide services to individual customers, clients, or patients. So in such cases, the customer, the client, or the patient, they can each be viewed individually as a job for which the costs are accumulated and then reported. So the primary product costs for a service business are direct labor and overhead costs. Obviously, because we're dealing with a service business, it's not necessarily materials, that need to be tracked. Any materials or supplies that's used in rendering services, they're normally insignificant. So as a result, those are a part of the overhead costs. So much like a manufacturing business, our direct labor and our overhead costs of rendering services, they're accumulated in a work in process account. And then whenever the job is completed and the client's billed, then the costs are transferred to a cost of services account. And just keep in mind, the cost of services is similar to the cost of merchandise sold for a merchandising business or cost of goods sold for a manufacturing business. And lastly, we have a finished goods account. It's not necessary, reason being because the revenue for the services provided are only after the services have actually been provided. So with this exhibit, it shows the flow of costs through a service business. So we consider our wages payable, whether it's direct labor or indirect labor. We consider the supplies that have been used up, and they have an impact on our factory overhead. And then from there, we factor in our work in process. And then lastly, we have our cost of goods services as it relates to the jobs that have been completed. And just a few key things to keep in mind. So in practice, obviously, there's some other considerations that need to, be taken into account. So for example, a service business, they might bill clients maybe on a weekly basis, maybe on a monthly basis, versus when the job was actually completed. So in such cases, portion of the cost related to each billing is transferred from the work in process to the cost of services account. A service business, they might also bill clients in advance. So they need to account for it as deferred revenue because it's unearned and they have an obligation to provide the service to that client. All right, so now we consider metric-based analysis for cost per unit. So a job order cost accounting system is one, as we learned, it accumulates and it records product costs by jobs. And we should know by now that our product costs consist of direct materials, direct labor, and our factory overhead. So the resulting total and unit product cost can be compared to similar jobs. It can be compared over time, or it can be compared to expected costs. So in this way, a job order cost system, it can be used by managers for cost evaluation, for decision making, and for performance analysis, right? So I don't want you guys to think that, what's being done, it's pointless, it's useless. Why is this even being done? Again, think of it from a management perspective. They need to determine, hey, are we selling these units? If not, hey, maybe we should decrease the price. Or is the demand for this unit high? Okay, then we should increase the price. Or maybe they see that their gross profit is less. Maybe they'll seek out new vendors who might sell wood for a cheaper price, sell guitar strings for a cheaper price. So that is why it is very important to utilize these metric-based analysis, because obviously before decisions are made, they need to look at the numbers to get a better understanding of what the potential impact would be of the decisions that are going to be made. So with this exhibit 17, here we see it basically shows the direct materials that's used in making the Jazz Series guitars for job 53 and 63. So the wood that's used in manufacturing the guitars is measured in board feet. And since job 54 and 63, they produce the same type and number of guitars, the direct materials cost should be about the same. But we see here that the cost for job 54, the materials per guitar was 100 versus job 63, where the materials for guitar was 125. So obviously the materials cost is more for job 63. So now management, they'll try to figure out, okay, well, what's this $25 difference? So for one unit, it's a small amount. But imagine if it's 100 guitars, the numbers add up. So management wants to be able to determine, why is there such a difference between the cost of the material for job 54 versus job 63. Next, we move on to just-in-time processing. So the objective of most manufacturers is to produce products with high quality but low cost, and that they can be instant availability for the product and everything that's needed. So with our just-in-time processing, it's a management approach that focuses on reducing time and cost and eliminating poor quality. So with just-in-time processing, it achieves efficiencies and flexibility by reorganizing traditional production processes. So in a traditional manufacturing process for a furniture manufacturer, the product, which is the chair, moves through 7 processes. And the product moves from process to process as each step or function is completed. So here we have the example. We're working with a furniture manufacturer. We start off with the direct material, then it goes through the cutting process, the drilling department, sanding department, staining department, varnishing department, upholstery department, the assembly department, and then now we actually have the finished good. So in the traditional production process, supervisors, they enter materials into manufacturing to keep all the manufacturing departments, the processes operating. Some departments, however, they may process materials more rapidly, faster than the others. In addition, let's say one department has to stop because a machine breaks down, right? So in such case, they need to account for idle time. And then they might be a buildup in work and process inventories in result of what happens in a various department. So in a just-in-time system, processing functions are combined into work centers, and sometimes it's referred to as manufacturing cells. So in just-in-time manufacturing, work centers, they complete several functions. The activities that's supporting the manufacturing process can be called service activities, such as repairs and maintenance of manufacturing equipment. Service activities may be assigned to individual work centers rather than a centralized service department. And each work center is connected to other work centers through information contained on a Kanban. And this is a Japanese term for cards. And the primary objective of a just-in-time, a JIT system, is to increase the efficiency of operations. So when we're using this just-in-time manufacturing, workers, they're often cost trained, right? So that way they can perform more than one function. So someone who's working in the cutting department, they might also know how to do drilling and sanding. So, that can help to streamline the process. So research has indicated that workers who perform several functions, they identify better with the end product, the end result. In a just-in-time system, the product is often placed on a movable carrier that's, centrally located in the work center. So it's, using a machinery that is carrying it all throughout the work center, much like they call it like a process line, like a working line like they used to have, back in the day. So after the work is in the center, they've completed their activities with the product, then the carrier and any additional materials, they're moved just in time to satisfy the demand or the need of the next worker. So in this case, the product is said to be pulled through production. So here in this example, we have the direct material. So we have work center 1, where there's cutting, drilling, and sanding. Work center 2, where there's staining and varnishing. And then work center 3, where there's upholstery and assembly. And then now we have lastly objective 8, which covers activity-based costing. So sometimes there might be complex manufacturing systems that produce costs that can be distorted if, let's say, maybe there's inappropriate factory overhead rates that are used. So one way to help avoid this distortion is by using this activity-based costing method. So this approach helps to allocate factory overhead more accurately than does if they have a single plant-wide overhead rate that we, saw earlier in this chapter where there was a $5 factory overhead rate. So the activity-based costing method uses cost of activities to determine product costs. Under this method, factory overhead costs are initially accounted for in an activity cost pools, and they're related to a given activity, such as machine usage, inspections, moving, production setups, and engineering activities. So many service companies, they find that a single overhead rate, it can lead, as we pointed out, to service cost distortions. So many service companies, they use activity-based costing in order to determine the cost for providing services to their customers. So cost pools, as we just pointed out, it's related to a given activity. And much like manufacturing businesses, service companies, they need to determine the cost of services in order to determine pricing. Maybe if they want to have a promotion, and any other decisions is ultimately dependent on what is the cost of the service. So here we have this example with Hopewell Hospital. Based on that admission, it's $180 per admission. Radiological testing, $320 per image. In the operating room, it's $200 per hour. Pathological testing, it's $120 per specimen. And dietary and laundry, it's $150 per day. So with Hopewell Hospital, the first step is that they essentially need to determine what is the activity cost pool. So in this case, we have 5. Admission, radiological testing, operating room, pathological testing, and dietary and laundry. And then they also determine the activity rate for each cost pool. And again, just keep in mind, these cost pools are estimated based on the patient. So here we have a quick calculation of activity rate. So it states, assume the following data for radiological testing. So we estimate that there's going to be a budgeted cost of $960,000, and we estimate that the activity-based usage is 3,000 images. So we calculate it the same way. The budgeted activity cost, which is our numerator, 960,000, divided by our activity-based usage, which is 3,000, and that gives us a cost of $320 per image. So our activity cost allocated to each patient equals the patient activity usage multiplied by the activity rate. So here are hospital overhead services, our activities performed for Mia Wilson. So Mia Wilson is one person, so there was one admission. She needed 2 radiological tests. She was in the operating room for 4 hours. She had 1 specimen, 1 pathological testing, and dietary and laundry for 7 days. So in order for us to determine the cost for this patient, we multiply accordingly. One admission multiplied by $180 per admission, 2 images multiplied by $320 per image, etc. So we get a total cost of $2,790. And then from there, patient costs, they're able to determine a patient profitability report. So patient activity costs, they can be combined with direct cost information. These costs and the related revenues, they can be reported for each patient in a patient customer profitability report. So this report, it can be used by the hospital's administrators, and they'll use this report to determine their pricing or their services. So for example, here we have Kim Adcock, Brian Barini, and Don Conway. So here we see we had operating income. We had a positive for Kim Ada. We had a loss for Brian Barini, and we had profit for Don Conway, as well as profit for Mia Wilson. So now we need to determine, why did we have a loss in Brian Barini, right? Is there a reimbursement that we should have received from the insurance company? Hopewell, maybe they might reach out to the insurance company to reimburse the services, or maybe they'll request higher insurance reimbursement on other services. So again, now they can break it out, not just, based on a total, because obviously if we base it on a total, the numbers will be skewed, but we can look at it from an individual patient perspective. And then from there, the hospital and other service-based companies, they can make the decision on whether or not they want to increase prices or decrease prices. All right, and this brings us to the end of chapter 9, manufacturing operations. So now that the lesson has ended, you should have learned how to describe the nature of managerial accounting, describe and illustrate manufacturing operations, including the different types and classifications of costs, describe the types of cost accounting systems, describe and illustrate a job order costing accounting system, describe and illustrate the use of cost per unit for managerial decision-making and perform an analysis, describe just-in-time manufacturing processing, and describe and illustrate activity-based costing.